Hi, this is Tom Kestler with Kestler Financial Group. Welcome to this issue of Concept Classroom. Today we're going to be talking about index annuity pricing. We get a lot of questions from our advisors about index annuities and why the carriers are changing prices or changing rates or participation rates so frequently. And oftentimes they believe it's the insurance company just kind of jerking around prices and quote unquote. In reality, what's happening is the insurance companies are responding to changes in the marketplace, changes in interest rates, changes in the index, and so forth. So with this session, what I'm hoping we can do is drill down on some of the things that affect the way an index annuity is priced so that there aren't any surprises going forward. When you look at index annuity pricing, there's really three things that will drive the way that product performs. The first thing is the option budget. How much money does the insurance company have to spend on options, whether it's S&P options or Dow options or whatever? That's the budget. What can I go to the store with to buy my options? The second thing is volatility of the underlying index. The more volatile the index, in other words, the more it moves up and down, the more expensive the options become on a per unit basis. And then finally, the term of the option. Options, like pretty much anything else, are priced in quantity. The more you buy at one time or the longer the terms of the option, the less expensive the options become on a per unit basis. So the three of these combined are what drives how an insurance company will price their product. So let's take a closer look at it. If you were an insurance company yourself and you were going to issue a traditional fixed interest annuity, not an index, but a fixed interest annuity, let's assume your portfolio, your bond portfolio is yielding 6. You're doing pretty well. The first thing that happens is the company peels off, or you would peel off your profit. That 2% is a rough number. That's about what most carriers will make in what we call spread. And that's where they make the vast majority of their income, is in the spread in the portfolio between what they're earning on the portfolio and what they're paying off to benefit the customers. In this case, that would be 4%. If the product itself had an internal guarantee of 2, then that would mean there would be excess interest of 2%. And if you were going to issue a traditional fixed interest annuity based on these numbers, you'd issue an annuity with a 2% guarantee plus 2% excess interest for a total first-year guaranteed yield of 4%. That's exactly how a fixed interest annuity works in today's world. When you kick over to an index annuity, the math is identical. If your portfolio is still earning 6%, the carrier, you, are going to peel off your 2% profit. You've still got the same 4% to go to work for the client. If your guarantees are 2, then the only difference between a traditional fixed indexed annuity and a fixed annuity is that the option budget is that 2%. In other words, that extra 2% is what we've got to go shopping with to buy the options. And then finally, we don't know what the first year yield is going to be because it could, again, these are guaranteed products. They can't go below a 0, but the first year yield is going to be a function of whatever those options are doing over time. So let's fast forward to today. Again, this is simple math. Let's take a look at what's actually going on in today's world. When you look at interest rates today, the reality is the bond market that the insurance carriers are dealing with is probably in the 4% range. A good rule of thumb is if you look at the 10-year Treasury, most insurance companies are going to earn about 200 basis points above whatever the 10-year Treasury is. And 10-year Treasury today is below 2%, but let's assume they're earning 2, or the Treasury is 2. That means the carrier is earning 4. They're still going to make the same profit. They got to keep the lights on. That means there's only 2% to go to work, and over the last few years, most of these carriers have been able to negotiate lower guaranteed rates just because the yields on their bonds have come down so far. So the guarantee might be 1% internally, which means that there's a 1% option budget. We don't know what the yield is going to be over the first year, but notice that a 33% reduction in the portfolio yield equated to a 50% reduction in the option budget. So as rates have come down, minor changes in the portfolio have created some pretty substantial changes in what's left over for the options. So basis point changes in the portfolio can make some pretty big differences in the rates, and that's why we see some pretty rapid fluctuation in today's marketplace. Let's take a look at volatility. This is the S&P 500 over the last 2 years. As you can see, there's a lot of ups and downs, and that's really the volatility. When you think about how much it goes up, how much it goes down, that volatility is what adds expense, especially if you're buying S&P options. So that's traditional S&P index. For comparison, this is the JP Morgan Mosaic Index used by Nationwide. This is a volatility controlled, asset allocated type of index. There are changes up and down, but nowhere near as volatile over the same 2-year period as what the S&P is. So if you can reduce volatility one way or another, that small option budget will allow you to buy more of the stuff, in this case the JP Morgan Mosaic, than you would be able to buy in the S&P because of its volatility. This is the VIX, or the Volatility Index. This is not the S&P, but this is basically a measure of how rapidly the S&P is changing up and down. As you can see, there have been some spikes here and more recently here when Great Britain exited or announced they were going to exit the EU. When you get those kind of spikes, volatility goes up, the cost for the options will go up, and that will tend to drive what insurance companies will do at that point in time because they're buying those options as we speak. Increased volatility is an increased cost per unit. And then the final thing is term of the option. Just like going grocery shopping, if you were going to go out and buy 1 egg or 2 eggs, it's going to cost you a certain amount of money. But if you bought a whole dozen at a time, it's substantially less expensive than buying 12 eggs one at a time. The same thing happens when you're looking at options. The longer the term of the option or the larger quantity options you're buying, the better pricing you're going to get as an insurance company. When you go back to the original index annuities back 20-some years ago, they were first issued as a 5-year point-to-point design. That meant there was one good day every 5 years, and it was, trust me, for 1,825 days. You put in your $100,000. First year you got a 0, second year you got a 0, third year you got a 0, fourth year you got a 0. The 5th year, interest would be credited and it would renew for another 5 years. In hindsight, they were very good performing products. The problem is they were a bear to keep on the books and a bear to sell because the client saw zeros for 4 years before they got their interest credited. So the industry standardized on the annual reset design, or the 1-year point-to-point type of design. That meant there was one good day every year. That's basically the policy anniversary date. And the trust me term came down from 1,800 days to 365 days. So any transaction that occurred mid-policy term, you got policies issued February 1st, anything that happens on any date other than February 1st, the carrier had no way of calculating the interest at that point in time. So on any triggering event, whether it's an RMD or a free withdrawal, any uncredited interest would be forfeited at that point in time. Not necessarily bad, it's just the way it works. And Nexus came out with their patented daily pricing. For the most part, their products today are 2 or 3 year point-to-point designs. But the pricing is daily, so every single day is a good day. Any triggering event, the ability to capture any uncredited interest, and there's no trust me at all because whatever you see is what you get. So when you look at index annuity pricing, again, there's 3 things. You've got the option budget. Everybody's in the same boat there. Everybody's buying the same options. Everybody's working in the same interest rate world. So the budget is what the budget is, assuming carriers are making the same profit. If they're willing to cut their profit, they can buy more options, but I don't think I've ever seen an insurance company willing to cut profits. Volatility of the underlying index, decreased volatility reduces the cost per unit, which is why a lot of the carriers are moving towards the more proprietary indices with volatility control. And then finally, the term of the option. Options are going to be cheaper by the dozen. The more you buy, the less expensive they are. So the 3 bullets combined are what drives how these things are priced, and it all starts with how much do I have to spend. Hope you enjoyed this session of index annuity pricing. Be sure to stay tuned for some more of these ongoing tools. Hopefully these will help you in your practice.